Hello, everyone, and welcome to today's webinar. Okay. My name is Sanket, and I'm the Marketing Manager at ISI Emerging Markets India. And the topic for today's webinar is IL&FS crisis and the financial sector in India. For those of you who have joined us, I would like to thank you all for joining us today. Before we get started, I would like to go over a few items so you know how to participate in today's event. You're listening in using your computer's speaker system by default. If you would prefer to join over the phone, just select telephone in the audio pane and in the dial-in information will be displayed for you to call. You will also have the opportunity to submit text questions to today's presenter by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation, and we'll collect these and address them during the Q&A session at the end of today's presentation. So while we wait a couple of more minutes for other attendees to join in, I would like to start with a little introduction. For those who are not familiar about ISI Emerging Markets, our group businesses CEIC and EMIS are two of the leading data providers of economic data analysis and research. Now, EMIS is an online platform used by thousands of professionals around the world who look for company, industry, and country information in and on emerging markets. And CEIC is also an online platform for accurate macro and microeconomic data covering over 200 economies, 20 industries, and 18 macroeconomic sectors. CEIC is used by the likes of the IMF, two the largest asset managers in the world. Now, today's webinar will be presented by my colleague Rohini Sanyal, who is the research economist with us. Now, before I hand the control to Rohini, I would like to mention that we also have a handout section just above the question panel where we have uploaded the presentation for your easy reference. Now, with that being said, over to you, Rohini.
Thank you, Sanket. Welcome, everybody. This is our first India webinar on the shadow banking crisis and the Indian economy, which focuses basically on what happened with the IL&FS crisis and the financial sector. We have chosen this topic to understand why the shadow banking sector suffered such payment defaults and what the impact on the market was both then and now, and more importantly, how it affected the economy. So to start off, without beating around the bush, what really happened in September 2018? IL&FS, once a leading AAA-rated infrastructure financing firm, fails to meet a series of payment obligations on letter of credit payments, interest payments on non-convertible debentures, also obligations with respect to like bank loans, dues of corporate deposit, and commercial papers. This amount totaled to INR 910 billion, which is approximately 90,000 crore. As a result of this default, credit rating agencies downgraded the debt instruments of IL&FS. Simultaneously, the DSP mutual fund, which was selling the commercial papers of DHFL, which is Diwan Housing Finance Limited, in the secondary market, started doing so at a discount rate to finance this sudden surge in redemption, which was created by the IL&FS. Now, these two events essentially contributed to squeezing out the liquidity from financial markets and then shook the investors' trust in NBFCs. This was known as India's Near-Lehman moment. So why was it called India's Near-Lehman moment? So when we compare the two events, we actually see some eerie similarities between the time when USA subprime mortgage crisis started in 2008 and India's NBFC crisis in 2018. The Lehman Brothers Investment Bank at that point was lending to a subprime market, and the market itself was fraught with risk in a manner very similar to that happened with IL&FS. They had investments that had project delays, they were risky, and there was basically a big asset liability mismatch. However, we have to also see that the Lehman crisis was much bigger due to its size and the linkages it had all over the world. In India's case, IL&FS is a very big entity, but the effect of the crisis was sort of averted by the government stepping in and replacing the board soon after the event took place. So what led IL&FS to payment defaults? So when we look at this, IL&FS had backed several big projects that required huge financing, and essentially it led to a debt buildup of about 90,000 crore or 90 billion. The projects had their own risk issues, as I just mentioned: cost overruns, protracted implementation, delayed or withheld regulatory approval, natural calamities, and so many more incidents. But most importantly, what happened was the complex organizational structure of IL&FS played a huge role in ballooning this crisis. And in fact, the layers of the company made it very difficult to detect the stress early. Now, and DHFL, on the other hand, started experiencing issues about 4 months after the crisis really happened. In fact, at the time of the crisis, DHFL was only having issues because of the redemption pressure, and it wasn't a full-blown crisis in itself. The financials were okay. But 4 months after, in January 2019, we see that DHFL siphoning money through the shell companies, impacting its reputation, and leads to subsequent downgrades by all the rating agencies. So, and for those who've been following the incident, RBI has now filed for insolvency proceedings on behalf of DHFL, superseding their board, and it's officially now the first NBFC, or rather, a housing finance company to face insolvency proceedings. So, what was the market impact, market reaction to all these incidents? Well, the big crisis. Equity markets and sovereign bonds. So we see that in terms of the equity market, the domino effect of IL&FS crisis as well as the DHFL sell-off led to this market-wide rout on 21st September. And hence the intraday Nifty 50 index plunges by 480 points, and it breaks this 11,000 mark that would provide everyone with this psychological support. Sovereign bonds were also impacted by the tight liquidity conditions and exerted an upward bias on bond yields. There were other coinciding events, which increased the pressure on equity markets and government bonds, such as the US-China trade war and some borrowing announcements. So it's very hard to sort of pinpoint to just one particular, but of course, the crisis in itself led to a huge drop. But the following month, we would see that the Nifty 50 comes down to about 10,500, and that for that, the causes were sort of mixed into one bag. So when we look at corporate bonds and liquidity, we see that both. I beg your pardon. When we look at corporate bonds and liquidity, we see investors started moving more towards sovereign bonds. And as a result of that, the corporate bond market started seeing higher yields. Now, in terms of yields, the 5-year AAA corporate bond softened from 8.86% at the end of September 2018 to 7.4% at the end of September 2019. This fall, however, is still slower than that of a government security, which suggests that there is a higher risk premium that is associated with the NBFCs, especially in the aftermath of the crisis. The bond yields, or the yield differential as such, was about 0.6 basis points at the start of September last year, in 2018, before the advent of the crisis. That increased around 70 basis points to reach about 152 basis points at the end of August 2019. Now, the system liquidity underwent several turmoil because of all these developments. Uh, as a result, banks and mutual funds both became averse to funding NBFCs. The asset liability mismatch in the operations of NBFCs, such as IL&FS, became a fundamental issue, which meant that these firms would have to raise capital from the markets for 3 to 5 years, which is their short-term loans, but lend for longer periods like 10 to 15 years. Now, this is a perfect scenario to drive out all these potential investors from debt instruments that are issued by the companies, and makes it difficult for NBFCs to roll over credit lines and uh, increases the lending rates even more. Now let's look at mutual funds. Mutual funds, as I mentioned before, face several severe redemption pressure post-crisis, and the funds had to and they had to liquidate a lot of their high-quality debt papers to meet this sudden surge in redemption requests. Now, the returns were impacted, and the proportion of lower-rated papers in the mutual fund market increased. Deployment of debt funds by mutual funds in NBFCs has also been declining. Investments from banks in commercial papers dropped by 37% year on year in May 2019 to about 907 billion, while investment in mutual funds fell by 28% to about 489 billion. And you can see it in these graphs here. So we take a look at the overall NBFC sector. What is the sector about? Classification of the NBFCs. Now, a lot of us know that NBFCs are a type of non-banking financial institution. As you can see, there are three kinds of non-banking financial institutions, NBFCs being one of them. Further, NBFCs can be classified on the basis of liability structure, which comprises of NBFCs, which are deposit taking, and then there are NBFCs, which are non-deposit taking. A lot of you may know this as NBFCs D and NBFCs ND. The second way of breaking it down can be by that of systemic importance. This is usually for all the NBFCs which are non-deposit taking. And in this case, NBFCs non-deposit taking, which have more than 5 billion in assets, are categorized as systemically important. The last categorization by activity is particularly important from a regulatory aspect because it's breaking down the NBFCs by activity. We will cover a bit of this in the regulatory section as well. There are a total of 10 segments here. However, in our presentation, we will be referring most of the time to using the liability and the systemic importance structure, which is NBFCs, which are deposit taking, and NBFCs, which are non-deposit taking and systemically important. When we look at credit growth in the NBFCs, we see that there has been quite a lot of growth in terms of credit given from NBFCs to these various sectors. Here we can see that large industries have occupied rather a big portion of the NBFC credit. The growth rate of NBFC loans, in fact, the NBFC loans and advances was much higher than that of the scheduled commercial banks. And even though in absolute terms, the banks occupied a much larger share of the credit market. But here we have to keep in mind that NBFCs are catering to the credit needs of uh, uh, very niche industries. I wouldn't use the word niche as such, but yes, industries that require long-term financing, perhaps. So probably like credit needs of retail, medium and small industry sectors, which are also one of the driving forces behind the rise of NBFCs. Infrastructure loans are another segment that has added to the expansion of credit from NBFCs. The highest credit flow has been to the industry sector here. You can see it's, if I measure it by percentage, it'll be around 52% of the total, and then followed by retail sector, which is around 22%, and services sector, which is around 18% actually. So but one of the main problems that we are seeing with NBFCs now that the NPAs of NBFCs have increased substantially over the years. So if you're looking at financial year 2014, you'll see that the gross NPA was at 2.6, while the net NPA is 1.4. And then this number in 2018 is at 5.8 and 3.8 respectively. So there's a huge increase in the GNPAs and the NNPAs. However, it's interesting to note that from 2017 to 2018, there is a fall in the GNPAs of NBFCs. Now, if you look at the borrowing outlay of NBFCs, here we can see that the slide shows the different sources of credit for the two types of NBFCs. As I mentioned before, we have NBFCs which are non-deposit taking and systemically important. I've included the breakup of their borrowings for September 2018. And you can see that debentures, banks, and commercial papers are something that is been very popular with the NBFC systemically important. Similarly, for the NBFCs which are deposit taking, however, the difference between the two is that NBFCs which are systemically important have a breakdown in terms of secured borrowings and unsecured borrowings outlay, while NBFCs which are deposit taking only have a total borrowings outlay. Now let's discuss the regulatory framework. Now this is very important, of course, given that everything that has happened in the NBFC sector, and especially how the public sector banks, when they were undergoing their crisis a few years back, in fact, even till last year, their NPAs rose quite a bit. And now just this year, it has started to show a decline, which is probably talking about how the RBI's regulations have been very effective. So in a manner very similar, we see that these kind of regulations are now in demand for the NBFC sector because of all these issues that we have just spoken about. So to start off with, we have a multi-regulator model. NBFCs have to obtain this certificate of registration from RBI and have to have like net owned funds of about 2 billion in Indian rupees, in line with the section 45(1)(a) of the RBI Act. If anyone wants to have a look, they can have a look at it through the RBI website or email us. We will send you a copy. However, certain classes of NBFCs are regulated by bodies other than the RBI. These bodies are exempt from the registration requirement under section 45(1)(a) to avoid dual control, basically. NBFC's tier 1 and tier 2 capital should not be less than that of 15% of their on-balance aggregate risk-weighted assets and of risk-adjusted values of off-balance sheet. There's a very complicated sentence there. But the minimum tier 1 capital requirement is 10%. Recently, the RBI took over housing finance companies from the National Housing Bank, as you can see here that I've highlighted. So this basically happened because there was this uh, uh, concern by the government that we can have better regulation under the RBI. So they have moved housing finance companies, and in fact, RBI has used this very power to sort of start off with DHFL's insolvency process. So let's have a look at some of the major regulatory aspects that the RBI and government have introduced. Risk weight. Now, risk weight is basically this concept where earlier AAA rated NBFCs would also have a risk weight of 100%. So it was sort of equal for every NBFC the through the entire sector. However, RBI introduced the concept of this risk weightage being assigned as per risk ratings, and it's in a manner that's similar to those done outside that of NBFCs or HFCs. For like corporates, you will see risk weightage being assigned as per risk ratings. So as a result of that, now the AAA rated NBFCs, which would attract 100% risk weightage, would now only attract a 20% risk weightage, and this would increase respectively for like each downgrade in rating. So essentially what this step will do is decrease the overall risk-weighted assets on account of NBFC exposure. Beg your pardon. Exposure norm. So under the large exposure frameworks, the bank's exposure limit to NBFCs was pegged at 15% of the Tier 1 capital funds, while for other sectors, it was at 20%. But in order to sort of harmonize the exposure limit to single NBFCs with that of general limit, the exposure limit for NBFCs was also increased to 20%. However, there is a cap on the exposure to single borrowers prescribed by the regulator, but that is only to reduce concentration risk. Now, liquidity through FALLCR. What is FALLCR? Is facility to avail liquidity for liquidity coverage ratio. Basically, what this does is so it improves credit availability to the non-banking sector, and as a result of that, commercial banks were permitted to treat government securities as level 1 high quality liquid assets under this facility to avail liquidity under the liquidity coverage ratio. Now, with respect to their incremental lending to NBFCs and HFCs, so any lending that happens after the 19th of October 2018, banks will now have the option of treating the government securities as level 1 high quality liquid assets. Now, the inclusion of these government securities within the mandatory statutory liquidity ratio, the SLR requirement of up to 0.5% of the bank's net demand and time liabilities, which is also known as NDTL, implies the availability of additional liquid funds. So what it does is that it reduces the pressure on banks to raise short-term funds and also basically give them an impetus to lend to NBFC sector. Now, furthermore to that, the CIC guidelines, this is something that tackles the organizational structure that we were talking about for IL&FS. And what IL&FS essentially had was about 4 layers of core investment companies within like one investment company, which was IL&FS. So in order to avoid such a complex structure for lending, capital contribution by a CIC, a core investment company, in a step-down CIC. So a step-down CIC is basically a subsidiary company of a CIC, which is a subsidiary of another company. So essentially, it's like a third layer of CIC, third less core investment company within the main core investment company. So capital contribution by a core investment company in a step down core investment company over and above 10% of its own funds would now be deducted from its adjusted net worth. And a step down CIC will not be able to invest in any other CIC. So this basically checks for any uh, transmission losses across the layers of core investment companies that was probably happening for certain investment companies. Um, Also, they have introduced a rule for like mandatory constitution of board level committees, including an audit committee, a nomination and remuneration committee, a group risk committee. So these are things that have been put in place to uh, essentially make the NBFCs stick to a proper framework. Um, this will help in regulation of the entire sector and ensure that everyone is following uh, proper rules to channel the credit in the system. Furthermore to that, as I was talking about, the Insolvency and Bankruptcy Code of 2016 has been modified by the Corporate Affairs Ministry for any NBFC with asset size of INR 5 billion or more. So this is basically, I think, targeted at NBFCs which are non-deposit taking and systemically important. And now they will be able to file for insolvency resolution and liquidation proceedings. Uh, Now, when they brought in the RBI, RBI has stepped in as an appropriate regulator. And since this can only be initiated by an application from the regulator, RBI has used the IBC 2016, the amendment to the IBC 2016 rather, to file for insolvency proceedings for DHFL. Some more points on this would be partial credit enhancement through banks, although this is something that has been available since some time now. Harmonization of NBFC categories to activity based from entity based, again, something that I mentioned earlier while discussing the classification of NBFCs, that RBI now is trying to harmonize NBFCs through categories. So, in fact, asset finance companies, loan companies are now categorized under a new category called NBFCs, which are credit, investment and credit companies. So, ICC, NBFCs, ICCs. Also, they have brought in the concept of appointing a chief risk officer for NBFCs, which have an asset size of 50 billion or more Indian rupees. So these are some of the main highlights of the changes in regulation. Now we come to the Indian economy. The relationship that NBFCs have with the Indian economy is quite important. And in fact, this is something that was not very prominent earlier, but is now even more clear. Now that we are facing a lot of issues where there is a slowdown in the economy. So it's interesting to have a look at what is really causing this. And while there are more than one reasons of that happening, NBFCs, the credit decrease from NBFCs is, of course, one of the big reasons of why there is slowdown in certain sectors. So NBFCs basically complement the banking system, even though in many ways they are probably competitors to the banks because they're using bank credit to sort of unbundle what they've been given and then sort of break it up and provide credit to others through other channels. But more importantly, NBFCs complement the banking system in providing finance to sectors like transport, infrastructure, and rural segments. NBFC financing, often targets groups and sectors that are not covered by mainstream banks. NBFCs develop their expertise in those, particular segments of the market, and they will usually customize their services to cater to those kind of segments. Let's say infrastructure for IL&FS, case in point. This financing now is often directed towards segments which usually would have difficulty getting financing from the banks. So Essentially, NBFCs are adding diversity to the financial markets and contributing to the depth of the capital market. Now, there are studies, and there's one study in particular which we can share with you. Experts find this increasing evidence of the strong correlation between development of financial intermediaries and economic development of the country. Now, this contribution is actually seen to increase where intermediation is provided through a very balanced combination of banks and NBFCs. So NBFCs and HFCs, well, housing finance companies, are financing this considerable share in the housing sector as well as automobile sector. So here you can see that, uh, whoops, you can see how auto loans form about 30%. So NBFC credit to auto sector forms about 30% of the total credit to that sector. That includes banks, private banks, and others. So 30% is quite a large number. That's 1/3 of the market. For home loans, similarly, it's 44%. These are figures from December 2018. Um, You'll also see property loans against property are at 53% from NBFCs and HFCs, which is sub- hugely substantial number. And NBFCs are seen mostly giving credit to auto sector, retail sector. There's the industry sector, which comprises of micro, small, medium, large industries, and industries other than large industry, all of these segments as well. Um, Going over to the next slide. Auto sales, as you can see, have dipped substantially since 2018 October, which is also, if you see, the time when the NBFC crisis happened. Now, it's interesting to note here that it's been constantly falling for quite some time now. It's been in negative numbers, as you can see here. This is your zero mark, and it's been in under negative numbers, like slightly picking up now. Uh, so auto sales, and this has been a major concern for the economy as well. Finished steel production, again, this is sort of derived from the construction sector, the real estate sector, which is also a big borrower of NBFC credit. And you can see that there's been a dip in the markets. It's quite volatile. So clearly something is not right here. And housing price index by the National Housing Board, National Housing Bank is shows how the assessment price here has gone down in quarter 4 of 2017, then it's gone down in quarter 4 of 2018. The market prices for construction of properties has gone down. So it's not it's quite volatile, as you can see, and this suggests that there is a lot of turmoil within the credit from NBFCs or credit in general from all sources, the financial sector. Stress in the sector may, also jeopardize finance need for these segments. The stress in MSMEs and auto sector is already, evident. Both the production and sales have been continuously declining, and the durable consumer goods, which is your index of industrial production, has also dropped. I just want to add it in here. And the ripple effect of all these troubles in the NBFC sector is now, sort of moving through the economy. And we can see that as a part of the economic slowdown right now. So we go to the current status and current scenario, way forward. We want to see how, post-crisis measures that were announced by the government have led to this increased flow of bank credit to the NBFC sector. It's quite strange in many ways that banks are lending more to the NBFC sector, but this is quite a targeted approach that has been taken. So government and banks have both, the government and RBI have both taken enough they've taken like enough uh, how do I say um, uh, the suggestions from NBFCs, and clearly, since banks are one of the major lenders to NBFCs, it was essential to have at least one point of credit in place. So this is what you see here in total bank credit and credit to NBFCs, and it's actually gone up since September, as you can see here, and which is a strange phenomena, but it's not. It's happening because of all the rules and regulations introduced by the bank, by the RBI, and by the government. Mm, as we just discussed, that partial credit enhancement, risk weightage, exposure norms, everything has been done in a way to encourage more lending from banks to the NBFCs to ensure greater credit in the market. What is also interesting to note is that the pace of the bank credit towards NBFCs is higher than the overall monthly pace of bank credit increase. So this, as I discussed, this is happening because the special financing window that banks have been allowed by the NBFC for the NBFCs to receive credit through all these different programs. The registrations and cancellations, as you can see here, has spiked particularly in 2019, and this is again showing a result of the RBI regulations, and a lot of NBFCs in recent times have had their registrations cancelled because of issues with their financials or issues with their structure, all of these reasons. Uh, what is important now is to see that how do we go forward from here. Uh, it's a very thin line to tread between regulation and innovation. So you have to, while you want to balance regulation, um, you need to just have enough rules in place that will allow for better quality assets, but at the same time you need to also give enough leeway to encourage investment in all these innovative or different uh, sectors which are not getting traditional financing. So it's a big responsibility to have on banks, on RBI and the government. uh, Also, the various financial sectors have to come up with a greater degree of transparency, perhaps, to ensure that the NPA problem is solved before it goes to a level where the public sector banks went. And I think everyone's hopeful that this issue should be resolved sooner than later because of all the regulations that are being now put in place. So that's it from my side. Sankeet, do you want to?
Well, thanks, Rohini. I must say it's a really interesting and insightful analysis of the NBFC issue in India. Now we'll open the floor for question and answer session for today's presentation. Just as a reminder, just would like to highlight again that you can still submit your questions through the questions pane in your attendee control panel. Okay, now let's see, what are the questions? Okay, question number one. NBFCs lend a great deal to the MSME sector, but here in this presentation, it shows that large industries are largest recipients of the credit dispersed. What explains that?
Okay, good question. Well, it's basically happening because of the ticket size. So basically, large industries have larger ticket size, and the MSME sector relies heavily on the in NBFC sector for credit. But the value of the loans given out to large industries occupies a much larger portion of the total credit given out, if that's making sense. Well, so MSME sectors essentially are borrowing a lot. A majority of the MSME sectors are borrowing from NBFCs, but it's not being reflected because they have smaller ticket size. That's the reason.
Okay, that's great. Now, let's see. The second question, oops, sorry. The second question is, how did the NPAs of the NBFCs go down in FY 2018?
Okay, that's that's a very hard question. Unfortunately, it's again very difficult to sort of pinpoint a particular reason for this. Uh, we must remember that just prior to the NBFC crisis, we were having the issue with banking sector, and they were reeling from the issue of increasing NPAs. Since banks and mutual funds, are were a major chunk of providing credit to NBFCs, it is possible that banks became more careful in lending to the NBFCs, and that in turn caused the NBFCs to sort of keep a check on their bad loans. So maybe that's one of the reasons, but it's very difficult to say again. There's not a lot of data available, as you all may know, with respect to NBFCs, and it makes it a little more difficult to analyze this.
Okay, thanks, Rohini. I can see a lot of questions coming in, and it's always good to have an interactive audience. We will take one last question for today. However, in the interest of time, we request you to write your questions to Rohini directly on the email ID that you can see, which is rsanyal@isimarkets.com. So with that, we'll just take one last question by Catherine. What is the share or amount of secured and unsecured lending by NBFCs and SI?
Okay, once again, I'm just going to read the question again. What is the share or amount of secured and unsecured lending by NBFCs and the SI? This is actually available from your RBI data. I don't have it open right now, unfortunately, but I'll be very happy to respond back over an email. I'm sure Sanket can share your email ID with me, and I will send you the file and an answer for your question if that is okay.
Right. Thank you, Catherine. We will reply to you over email with a detailed question. Okay, we'll take one more question, which is okay, 53% of property loan and 44% of home loan from NBFCs. Real estate slowdown is driven by NBFC fall. Since consolidation happening, increasing number of cancellation and increasing percentage of bank credit to NBFC, would it impact real estate positively? Any idea when it is likely to take off? Thank you, Raja, for such an interesting question.
Okay, hi. Yeah, thanks. It's actually a really good question. Uh, well, it's again really hard to say why if one caused the other, because if you remember in 2016 when demonetization happened, that gave a big jolt to the real estate market, and then subsequent to that, the RERA was introduced. So we those impacted the real estate market as well. However, what you're saying correctly is 53% of the property loan and 44% home loans were given as credit from the NBFCs, and it's possible that it will slowly take off now. I would love to discuss this with you maybe over an email. Because it seems like now with all the regulations in place, the credit to the NBFC sector will increase. And as a result of that, because real estate is such a big aspect of the NBFC lending, it would definitely generate much better, for the sector. It would do much better for the sector. I hope that answers your question.
Well, thanks a lot, Rohini. Now, okay, to the ending bit. Once you leave today's webinar, you will receive a survey on the presentation, and we would appreciate if you would complete that and provide your valuable feedback to us. Having said that, you will also receive a follow-up email in 24 hours of this webinar with the link to view a recording of today's webinar along with the presentation. If you'd like a demo of a product designed for your requirements, you can visit our website emis.com or ceicdata.com to submit your request. Now you can see I've also displayed the product managers for the respective products, so you can directly write to them as well in case you're interested to see our product and get a demo done. I think with that, we conclude today's webinar. On behalf of ISI Emerging Markets, we thank you again for joining us today. I hope you have a fantastic day ahead. Thank you so much.